Paying for college, a back-to-school tax break refreshener. With college being one of the biggest expenses your family will face, it only makes sense to help them find some relief from a tax perspective. With that in mind, Thomas Ruckler's editor has compiled this quick checklist of tax opportunities to go over with your family during the next sit-down with them. The list is brief and general, so for more information and more specifics, refer to IRS Publication 970. First, a bit of non-news. College is expensive. Last year, private colleges averaged over $31,000 per year. But there are some relief available from the tax perspective. This will give you a brief general overview of some tax relief available for dealing with education expenses. You can use it as a checklist to go over with your family during the next sit down with them. But remember, the list is brief and general. For more information and more specifics, you should refer to IRS Publication 970. This publication is generally updated annually at the beginning of the year. The most current version is from 2014. This is important because, as discussed below, in 2014 there were deductions available for qualified tuition and fee expenses that are not available in 2015's tax return. Number 1. Taxation of scholarships, fellowships, grants, and tuition reduction. A scholarship or fellowship grant is tax-free only if the recipient is a candidate for a degree in an eligible educational institute. Fulbright grants, Pell grants, other types of Title IV need-based education grants, and benefits received from Veterans Affairs are generally treated as scholarships or fellowship grants. But payments that students at military academies receive are not scholarships and are includable in income. Qualified tuition reduction are generally not included in income. Number 2, American Opportunity Tax Credit. A taxpayer may be able to claim a credit in 2015 up to $2,500 depending on the taxpayer's income for adjusted education expenses paid for each student who qualifies for the American Opportunity Credit. 40% of the credit may be refundable. If the taxpayer elects to receive the credit, then he or she cannot claim the lifetime learning credit. To claim the full credit, your marginal income, modified adjusted gross income, must be $90,000 or less if you're single, or $180,000 if you're married filing jointly. Number 3, Lifetime Learning Credit. If a taxpayer cannot claim American Opportunity Credit, they might be able to claim the Lifetime Learning Credit. This credit is up to $2,000 for qualified education expenses paid for all eligible students. The credit is non-refundable, unlike the American Opportunity Credit. To claim the full credit, your marginal income, modified adjusted gross income, must be $52,000 or less, or $104,000 if you're married filing jointly. If your modified income is over $52,000 but less than $62,000, you can prorate that and receive a reduction amount of credit. Number 4, student loan interest deduction. Generally, personal interest paid other than mortgage interest is not deductible. However, if a taxpayer's modified gross income is less than $80,000, $160,000 for married filing jointly, there is a special deduction allowed for paying interest on student loans used for higher education. For most taxpayers, the adjusted gross income is figured on their federal income tax return before subtracting any deductions for student loan interest. The deduction can reduce the amount of taxpayers' income subject to tax up to $2,500 in 2015. Number 5. Student loan cancellation and repayment assistance. Generally, if a taxpayer is responsible for making the loan payments and the loan is canceled, the taxpayer must include the amount that was forgiven in the gross income for tax purposes. However, if the taxpayer fulfills certain requirements, two types of student assistance may be tax-free. The types of assistance are student loan cancellations and student loan repayment assistance. Number 6. Coverdale Education Savings Accounts. If a taxpayer meets the income requirements, he or she can contribute to a Cloverdale plan. The contributions are not deductible, but the income in the account grow tax-free until it's distributed. And the distributions are tax-free if the distributions are not more than the designated beneficiary's qualified education expenses at an eligible education institute. This Coverdale Education Savings Account is not just for college. It's for kindergarten, elementary, high school, as well as college. As long as the money is spent for the children's education. This is a good way of protecting income to be used for education. Number 7. Qualified tuition programs. Contributions are not deductible, but income in the plan grow tax-free, and no tax is due on the distribution unless the amount distributed is greater than the beneficiary's adjusted qualified education expenses. Number 8. IRA distributions not subject to additional tax. Generally, if a taxpayer takes distribution from an IRA before reaching 59.5, they must pay 10% additional tax on the early distribution. This applies to any IRA they own, whether it's a traditional or a SEP or a Roth or a simple IRA. The additional tax on an early distribution from a simple IRA may be as high as 25%. Retirement plans for small businesses are also a SEP IRA. However, taxpayers can take distributions from an IRA for qualified higher education without having to pay the 10% additional tax. They may owe income tax on that, at least a portion of the amount distributed, but they may not have to pay the 10% tax. Generally, if the taxable part of the distribution is less than that of the equal to the adjusted qualified education expenses, none of the distribution is subject to the additional tax. Education Savings Bond Program. Generally, taxpayer must pay taxes on interest earned on a U.S. savings bond. If they do not include this interest in the income in the year it is earned, they must include it in the year in which they cash out the bonds. However, when a taxpayer cashes in certain savings bonds under the Education Savings Bond Program, they may be able to exclude the interest from the income. Number 10. Employer-provided education assistance. If someone receives education assistance benefits from an employer under the Education Assistance Program, he or she can exclude up to $5,200 of those benefits each year. This means the employer should not include those benefits with the employee's W-2, tips, or other compensation shown on the W-2 box. If, however, this also means that the employee does not have to include the benefits on his income tax return, since the assistance is not included in the tax return. The employee cannot use it to determine any other deductions or credits. Number 11. Business deductions for work-related education. An employee who can itemize deductions may be able to claim a deduction for expenses he paid for work-related education. The employee's deduction will be the amount by which the qualified work-related education expenses plus other job and certain miscellaneous expenses is greater than 2% of his or her income. An itemized deduction reduces the amount of income subject to tax. Self-employment individuals can deduct expenses for qualified work-related education directly on their self-employment income, Schedule C. This reduces the amount of income subject to both income tax and self-employment taxes. Work-related education expenses may also qualify an individual for other benefits, such as American Opportunity Tax Credit and Lifetime Learning Credits. Taxpayers may qualify for these other benefits even if they do not meet the work-related business deduction requirements listed above. Also, work-related education expenses may qualify a taxpayer to claim more than one tax benefit. Generally, taxpayers may claim any number of benefits as long as they use different expenses to figure each one. Number 12, tuition and fee deductions. This is a trap for the unwary. As of 2015 and beyond, there is no deduction for qualified tuition and fee expense. For 2014 and prior, the deduction was more than $4,000 based on the modified gross income. So even though you got good deductions in 2014, those deductions are not here for 2015. If you have further questions, please contact my YouTube subjects or go to my website, backtobusiness.com, BACKTOBUS.com, and there is more subjects to help you with your taxes and business.